Good afternoon. Welcome to Market Today and our special edition on Market Masters. Our guest today is a very quiet but an intensely intelligent man, Mr. Hiren Ved. He's the Chief Investment Officer, co-founder and director of Alchemy Capital Market and advises or manages about $1 billion for ultra-HNIs, family offices and of course institutional investors. A very warm welcome to you, Hirenji. What a pleasure to host you at this time of the hour in markets. It's such a wonderful time that's happening for Dalal Street, and I'm sure there are no cause for complaints as far as markets are concerned. How do you think is the sentiment on Dalal Street, and where do you think we are headed?
Well, thank you. Thank you for having me today, both Shail and, happy to be here on BTV. Uh, well, I think, needless to say that the sentiment is very, very positive. And clearly, after the election results, the sentiment has gotten even more positive as investors are now factoring in that 2024 is in the bag and that there will be continuity of policy and the kind of momentum that we are seeing in the economy where, I don't know when was the last time where GDP growth was upgraded, your IIP is pretty strong, tax revenues are robust, and the markets are doing phenomenally well. So I think there is really no cause for concern. Now, even oil prices have started to behave. So I think for now, I think everything seems to be going well for both the Indian economy as well as the Indian markets, right? So, yeah, absolutely no cause for complaint at all.
Okay. So, Hiren bhai, where is the market headed from these levels? You've obviously mentioned the five major points of positivity as far as Indian stocks are concerned, but somewhere like 21,400 is what we are on the Nifty, and this has come in a very, very short interval over the last 2 weeks. If you see, we've appreciated about 7-8% on the Nifty alone. Where are we headed, say, 1 year from now, and how do you see foreigners reacting to this change that has happened electorally?
So, yes, we all believe because the markets, run up in the last 6, 9 months, especially the broader markets. The Nifty was actually now playing catch up. The large caps are playing catch up. And I think there is definitely more room to go ahead. Uh, if you just step back and look at the Nifty, you will see that uh, just before COVID hit, the Nifty was at 12,200. It peaked there and then it corrected. And now we are at 21,400, right? So, in a way, in 3.5 years, the Nifty has not yet doubled, right? But if you look at the earnings, clearly you will see that the Nifty earnings have doubled or more than doubled during this period. So I think Nifty will play catch up. Uh, as far as your question on foreign investors are concerned, well, I think they will take this extremely positively. As you all know that this government has led from the front, has focused on economic growth, and has done massive investments in infrastructure and capital investment over the last couple of years, and has also laid down policies which encourage domestic manufacturing in India. So I have no doubt in my minds that come 2024, while it has already happened in the last 2, 3 weeks, the FIIs have pumped in close to about 28,000 crores. There is more money to come in. I think India is a beacon of growth globally. And now that the Fed has also pivoted, I won't be surprised if there is more money that flows into emerging markets in general and India in particular.
Mr. Ved, good afternoon. Sakshi this side. Of course, you listed out all the positives on the back of which we are seeing this Santa rally go on. But we've been spoiled with these massive gains in a very, very short span of time. Would you say that the best or the best of the market rally is behind us now? And from here on, do you think the markets will take one step forward or two step backs?
Well, I think, even in a bull market, you do have corrections. So I think we have to be ready that nothing goes up in a single line. But broadly, if you were to ask me what the direction of the market is, I would say it's up, right? Having said that, I think one thing that we need to be careful about is the kind of euphoria that we are seeing in the IPO markets,
Yes.
right? I think
क्या बात है?
the level of oversubscription that we are seeing, the kind of parabolic price increases that we are seeing, especially in companies which have very low float. Uh, so I think investors have to be careful not to get carried away. There are always excesses that get committed in a bull market, and very clearly, there is one excess that I can see is in the IPO markets and in the low float stocks, right? So I think that's the only reason of concern and worry that investors need to keep in mind. It's very easy to get carried away in this kind of environment. But other than that, I think markets are pretty rational, and I think the growth visibility is pretty solid. And in my view, the direction is clearly up.
Fair enough, and I'm really glad, sir, that you talked about the IPO space. In fact, on this, we have a viewer question as well, and I'm sure the viewer will get greater clarity if you could expound upon your IPO point here. Ramesh Pawar from Mumbai has pointed out and wanted to know on IPOs versus listed stocks and where historically have we seen investors make more money. So, if you could give that clarity, because we've seen almost 200 to 30 IPOs come up, including both SIPs and main board IPOs already, and the frenzy continues. Even today, we've seen 3 more IPOs open up, and this is clearly a space that the small retail investors are really getting enticed with.
Yeah, I mean, I don't have much experience on the SME board, so I won't like to commit
Sure.
there. But clearly, from what I hear, I think there is a lot of euphoria there as well. Um, if you historically, look at the data, right? I think the data will tell you that very few IPOs actually companies make sustainable money over a long period of time. More often than not, you tend to get these companies at lower levels, post their listing. Now, whether it could be 3 months, 6 months, 1 year, it really depends. But I think investors have to be very, very careful. My sense is that there is very limited history when companies go IPO. Uh, in many of these cases, the floats are pretty low, so it's easy for these stocks to have a big move immediately post the IPO. But if you look at the data, less than 5% of the companies that go IPO are able to sustain the listing gains that they would have had. So I would still prefer to invest in the companies which are already listed and have at least a 3 to 5 year history of financial results. Um, I think in general, retail investors would be happier if they don't chase IPOs. I think a good time to invest in IPOs is when the market sentiment is very bad, because during that time, more often than not, you tend to get IPOs at a very decent valuations. In markets like the one that we are witnessing today, unlikely that there is much value left on the table. Very few promoters and bankers think long term and leave value on the table. And if there is value on the table, unfortunately, the level of oversubscription is so high that you really have to be lucky to be able to lock into an IPO price, right? So, on the whole, I would say be careful. Yes, there are always exceptions to the rule, but the rule has been that the a lot of the stocks in the IPO don't sustain their gains.
Right. Now, we are through with the easy questions, Hiren Bhai, and now starts the difficult part of the show. And I'd just like to give a very brief background on Hiren as far as our viewers are concerned. It is common knowledge on Dalal Street and in rarefied circles that if you wish to get a winning idea or a nice way to generate extra alpha, one has to definitely go and meet Mr. Hiren Ved on Dalal Street. So, with that background in mind and the fact that he advises only ultra HNIs and family offices, Hirenji, where do we put in fresh money?
Well, before you start, Shell, thank you for your very kind words. But I must say that I'm not the only smart guy on the street. There are several, uh, uh, managers who have done very well. But thank you for your kind words. I think, look, I've said this in the past that we are seeing a regime change in our market, right? There is a saying in a phrase in the markets that "Naye race ka naya ghoda," right? A new bull market has new leadership. And if you look at over the last 2, 3 years, especially after COVID, um, I think a couple of sectors stand out very clearly. Sectors that were leading in the bull market from 2003 to 2008, which is cap goods, manufacturing, auto ancillaries, real estate, and to that you can add sectors like defense and electronic manufacturing services, and the PSUs in some of these sectors have clearly done far better than other sectors, right? Your PSU banks have done phenomenally well. Your defense pack has done very well. Your power pack has done very well. So it's really the leadership in this market has changed from, let's say, the large private sector financials and NBFCs and the consumer franchises that were leading the bull market or were leaders of the market between 2010 and 2020. So I think while there is opportunities in every sector, that doesn't mean that you can't make money in private banks or in consumer stocks. But I think if you were to step back and look at who the winners in the last 18, 24 months, it's clearly the domestic uh, driven sectors which have done phenomenally well. And I think that leadership is likely to continue into the future, right? Um, so my sense is that auto ancillary, cap goods, real estate, manufacturing, power, all these sectors should lead going forward.
Okay. When you drill down into earnings of such sectors, especially autos as also power, both of them, of course, are already at record highs. The point I'm just trying to make, Hirenji, is should one be afraid of putting money at these levels, or is this par for the course? Is this rally here for good, or are we in some sort of a temporary, how should I say, parabolic curve on the Nifty, which just might taper off?
So I think, look, the markets currently are neither too cheap nor too expensive, right? And especially some of the sectors that I've mentioned have had a very strong run. So I think investors should be very careful that if they're investing today, they're clearly taking a 3 to 5 year view, right? I don't think that you can uh, invest with a 6 month or a 3 month view at current levels because clearly a lot of the future is also getting discounted in some of these valuations. Yes, we know that there is visibility in these sectors, and I also believe that leadership doesn't change so soon, right? This leadership is just into his second year. Typically, these cycles last for 8 to 10 years. So, yes, one should remain invested, and if one is investing fresh money, then very clearly do it in a staggered manner, or very clearly have a 3 to 5 year view from here onwards. And I don't think you will be disappointed. I can't say about the next 1 month or 2 months. As I said, there are always, even in a bull market, there are corrections, and one has to be mindful about that.
Sure.
एक्सेसिस तो बुल मार्केट में ही होते हैं ना, तो एक्सेसिस तो होंगे, बुल मार्केट में ही एक्सेसिस होते हैं.
क्या बात है.
That's wonderfully said, sir. The other question, of course, a lot of viewers would also have, and I wanted to just put forth on the new age tech stocks. You did mention the traditional stocks, the economy focused stocks, and the sectors that will be perhaps the drivers of the next leg of the rally. But what happens to these new age tech space stocks that have come back after posting some operational profits here and there, seeing the management commentary turn towards making profits and not just driving higher valuations? That was a big concern earlier.
I think some of the so-called new age or internet-enabled businesses are looking very interesting from a long-term perspective. In 2021, when they all debuted, I think the valuations were just crazy. They were not sustainable, and these companies weren't making profits or cash flows. I think that's changed. With rising interest rates, I think investors, and especially once you get listed, right, investors do ask or evaluate businesses on their ability to generate profits and cash flows. And I think the managements of these businesses have also realized that you can't have growth for the sake of growth, but you also have to build a business which, on a sustainable basis, is able to grow profits. But the good thing is that some of the good franchises, uh, you know, are leaders in their respective fields. Uh, Also, I think the hyper competitiveness of VCs and private equity investors throwing money after these ideas is now over. So capital is going to be very difficult to come by, which means that turning into profits and cash flows are going to be very, very important. I think some of these companies will really become giants over the next couple of years and will create tremendous wealth. But you have to really identify which those companies are. Unfortunately, I can't talk specific names, but I would suggest that investors either have a basket approach, so you kind of diversify your holdings across some of these companies, or you go to a professional portfolio manager or an advisor who will really help you to decide which of these companies that you should bet on. Again, these stocks can be very volatile in the short run because of their limited history, but many of them are now very quickly moving towards profitability and cash flows. And as I said, some of these are great franchises. They are leaders in their respective fields, and there is likely to be less competition going forward. So there is a reasonable likelihood of making good returns over the long run in this space.
Okay. Hirenji, when you sort of pause and reflect on the market, when your research team gets together on these days or over the weekend, what is the general tuning of the radar that you do these days? You've, of course, mentioned sectors such as auto ancillaries, capital goods, real estate, and power. Are you looking at frontline blue chips in these sectors, or are you sort of also looking at the next 10, 12 stocks? The understanding I wish to have is this a market to look for potential multi-baggers, or is this a market to look at maybe stocks generating 15-17% CAGR over the medium term?
Shell, uh, the thing is that you never know when you're investing whether a company is going to turn into a multi-bagger or not. It really takes 5-10 years. Believe you me, my experience tells me that it takes time. Very few companies are able to graduate from being small caps and mid caps to large caps. But yes, we've had many of them in the Indian market. But it takes time to get there. If you ask me frankly, at this stage, I would say that rather than looking for the next multi-bagger, on a relative basis, I think large caps do offer a better risk reward at this point in time. I would say in the near to medium term. Uh, but that doesn't mean that there aren't opportunities in the small and mid cap space. It's just that you have to have that kind of a time horizon. My sense is that we had a superb rally in the mid and small caps and the broader markets from the beginning of this financial year up until November. I think it's now time for the elephants to dance.
Yeah.
So I do believe, as I said, there are always exceptions, but I do believe that the better risk reward at this stage is in the relatively top 100 companies or the large caps.
Okay, that's a wonderful catchment to look into. And of course, as you say, higher GDP numbers, better GST numbers, as also sustained earnings upgrades have made this space a little more exciting compared with what it was 6 months ago. Hirenji, there are one or two sectors that have performed or underperformed dramatically. One of them, chemicals, and this other was large cap IT. Of course, when we sent the invite, large cap IT wasn't doing anything at all. But over the last 3 days, it's been a fantastic ride for the index as well as the two frontline heavyweights in the IT space. What are your thoughts on chemicals and large cap IT?
So, look, I think the chemical industry is still going through a little bit of a difficult time at this point in time. Um, the demand is softer in the Western world, which is where all these companies export to. There are inventory issues, especially if you're supplying into the agrochemical space. Uh, Longer term, I have no doubt that the specialty chemical industry is likely to grow multifold in India. But I think we had a very strong re rating of this sector post COVID. Valuations in many of these sectors reached 30, 40, 50 times earnings. And the earnings in the last, couple of quarters has been nothing great to write home about. I think the sector will take an opportunity. I think the fluff is gone, and one should keep an eye on the sector. At some point in time, the sector will turn around, but my sense is that it is going to take a couple of quarters. But overall, I there is an opportunity there. As far as large cap tech is concerned, um, yeah, I mean, we've seen a very strong rally. People were very circumspect about the sector, obviously, because many of the larger names, the growth was like sub 10%. Um, and there was a day and time when Nifty earnings were growing at only 5-6%, and these companies were delivering 12-15% return. And with their balance sheets and ROEs, they were very attractive. But last year, we saw a series of earnings downgrades from this sector. And also, I think that this sector is very sensitive to long term interest rates. Now that the Fed has kind of communicated that rates have peaked, there is a anticipation that tech spending will come back. I am of the view that tech spending should revive in calendar 24 and 25, driven by a new technology wave in artificial intelligence, right?
Okay.
So I do believe that there is more room for the sector to deliver returns uh, next year. We've just seen the first round, uh, and I think the sector holds promise. Indian IT companies have captured every tech curve, and I don't see a reason why we will not be able to benefit from the next cycle of spending in technology. So I continue to be positive, though our bets have largely been in the mid cap space, which have these companies have grown faster than the large caps in the last couple of years. But I think even the large caps should deliver reasonably decent returns from here onwards.
Right. Mr. Ved, was there any sector or a theme that you realized has enough potential, may have been missed by you, was a dark horse in 2023, and now you believe you need to track it as a structural long term story or a theme? Is there a space like that? I mean, I'm talking about, say, many analysts who we speak to say that, PSUs came up, as a big surprise how they unfolded. Maybe was there any sector like that for you that you identified?
Yeah, I mean, look, traditionally active managers have stayed away from PSUs because historically, PSUs never delivered sustainable returns, right? Because there was, these companies' balance sheets were not that great. There were constant regulatory interventions. But you're right that PSU as an entire space has just done phenomenally well, right? Have we participated? I think not to the extent that we should have, but we did participate in a couple of names in defense where there are certain monopolies. Having said that, in many of our quant driven funds, I think because they don't have any biases, they have wholeheartedly participated across the PSU space and have also benefited substantially. Um, is that an area that one needs to be, look at very carefully? I would say yes. But I would also say that, one should not rush into anything and everything that is a PSU, right? Because, I think each company and each sector within PSUs is different. Yes, I think there is, this government has created an enabling environment where PSU companies are being run more efficiently, more productively. They are also beneficiaries of the fact that, especially, I'm talking about the non-PSU, the not the banks, but the non-banking area within the PSUs, where they are also large beneficiaries of the capex cycle in spending in infrastructure and focus on getting stuff manufactured more within India. Um, so it's not a space that investors should ignore, but also it's not a space that one should get into blindly, and one should really pick and choose. And how much of your portfolio you want to allocate to PSUs across several sectors is something that one should be mindful of. But
Yeah.
certainly, this is an area that has surprised most, and I would say that without any doubt that the PSUs have been the leaders of this bull market cycle for sure.
Fair enough. In fact, this is the most sane advice that one can really listen to when it comes to the kind of stupendous rally that one has seen on PSUs, and what now should be really done when it comes to the FOMO that one may be feeling with PSUs as well. I'll take one or two questions from our viewers' choice now. The question that's come to us is from Parul Gupta from New Delhi, and she wants to know from you your stance on the banking space. She's saying that, you know, with the Nifty Bank now surpassing 48,000 level, what is the outlook for the entire banking space, and where exactly should she be putting in money?
Yeah, so I think we are positive on the banks. Uh, we don't see them leading the rally, but I think that they will play catch up given the fact that banks uh, uh, haven't delivered the kind of returns in the last 12 months for various reasons. So there will be some catch up that will happen. But I think they will give you decent moderate returns from here on as well. So the best way to do that is to just buy the top few high quality run private sector banks. Uh, I think all of them have done a reasonably decent job. Um, some of them who are also likely to be beneficiaries once the private capex picks up. The balance sheets are strong, capital adequacy is strong, credit costs are still benign, and there is a catch up rally which is still left in banks. So I think I feel good about the larger banks, and one should create a portfolio of the top two, three, banks and play that.
Hirenji, when we were discussing sectors yesterday, you've mentioned the traditional ones, which are auto anks, power, capital goods, and real estate. Given the way that our economy has also undergone a tremendous change as far as the underlying energy space is concerned, there are two new sectors which are coming up dramatically. One is the renewable energy space, whether it's on the financing side or on the main business side, and of course this broader theme of doing away with the fossil fuels, or at least reducing our huge dependence on them. How do you see that getting reflected in markets over the next 1 or 2 years? And what would you be buying there?
Look, I think traditionally power has been more like a utility sector.
Yes.
Suddenly it's become a growth sector given the kind of growth we are seeing in India. We are seeing peak deficit in power. While the long-term trajectory is to reduce our dependence on fossil fuel and incrementally add more capacity on the renewable side. But I don't think that we as a country will be able to reduce our dependence on thermal coal, at least for the next 5 to 10 years. It's going to take time, right? Because our power needs are growing. Yes, incrementally, maybe renewable energy will grow faster than traditional power, but you also need base load power, and therefore thermal will continue to be an important mix. Unfortunately, on the renewable side, there are a few companies, but there is not too much of a choice. I believe that over the next couple of years, you will see more companies in this area getting listed, and there will be more choices for the investors. Right now, the way to play some of the renewable companies is to buy some manufacturing companies who also supply into the renewable sector, right? Um, so that is a great way to play it. There are all the big utilities, who are in traditional energy are also investing aggressively in renewable energy. So you could look at some of those also for an investment. And you mentioned the financiers of energy. So far, that's been the most efficient way to play the renewable energy boom. You have the financiers, you have the big utilities, and then you have some of the engineering and manufacturing companies or component suppliers who supply some components into this industry, right? So these are the two, three ways to play. Hopefully, we will have more direct opportunities to play into the renewable sector. But I think the sector will do well for a couple of years. But we must also, I must mention to investors here is that, see, historically, something like power is a very basic utility, right? I think over a period of time, the government would not want unhealthy increase in power rates because this is a sector which the government could intervene if power rates have a runaway boom, right? So one should not, say that, okay, this deficit is there and power rates are going up and this will continue to be the case for a long period of time. I think in all sectors that touch the aam aadmi, right? Beyond the point, if there is an inflation in prices, the government does intervene, and we've seen that because for them, the overarching policy is to see that there isn't too much inflation. So one has to just be mindful of that as well. So I think the sector whole will do well, but one should not fool ourselves that the short term spike in rates and the rates of returns that some of these utilities make will be there for the next 10 years. That's not going to happen.
Okay. Sir, the other point where you see excessive growth and visible growth is the aspirational part of India. The people who buy Mercs, there is a waiting list. Lamborghini has sold its next 18 months sales target within the first 2 or 3 months of the current quarter. There is a huge demand for homes which are above 100 crore rupees, and of course there is a classic demand for everything which is a high end retail bag or a high end jewelry item. How are you sort of translating that theme into portfolios for ultra HNIs, portfolios for institutional investors, and of course family offices?
Yeah, so I think, one of the trend, especially post COVID, we've seen is that premiumization as a trend across consumer categories, whether it be luxury cars, SUVs, jewelry, or real estate or homes. I think that, uh, uh, you know, premium consumption has boomed in India, and that's largely the wealth effect that you are seeing, right? I mean, if your market cap of this country goes from 2 trillion to 4 trillion, obviously a lot of people are getting richer. And today in India, promoters own 40-50% of their companies, and if their market caps have gone up 3 4 5, in some cases 10x, they've become more wealthy, and I think incomes are also rising. So there is a small in the pyramid at the top, the 50 million uh, uh, consumers who spend like people would spend in the developed markets, right? So I think the luxury markets or premium consumption in India is likely to grow as Indians become more wealthy, more aspirational, uh, and I don't see that trend going away. You could play that in several ways. You yourself mentioned either through jewelry companies or luxury retailers or through high-end real estate companies which focus on the medium to top end of the real estate demographic, is a great way to play this. Travel, hotels. There are a lot of sectors that you could take advantage, but I think premiumization as a trend is here to stay. Um, and we continue to be quite bullish on this.
Okay, and the moment I spoke about high-end leather bags and jewelry, which is of a very high caliber, it was Sakshi's eyes that were sparkling. What's your next question, Sakshi?
Well, not certainly on the premiumization, which you've already asked, and something that always I aspire to go to. But let's see when that happens. Mr. Ved, the next question that's coming in from another viewer of ours, and that is from Soumya Sharma, New Delhi, and she wants to know from you in 2024 which asset will outperform. Will it be markets, will it be gold, or will it be real estate?
Oh, that's a tough one. uh, uh, Let me put it this way. Um, I think real estate in equity markets could be one of the areas that could do very well. I don't know if it is just going to be in 2024, but I think we are reasonably bullish about real estate, the the sector and the stocks listed in real estate, the good quality ones. I think because the sector has consolidated, and typically we've seen that whenever markets, capital markets do well, real estate follows. So they feed on each other, but it's usually the other way around. Once the markets do well, even real estate follows. So I would say that real estate in the stock market could do extremely well in 2024.
Okay. All right. I'll take another one then. The next question is from Adarsh in Noida, and he wants to know from you, where do you see the next sectoral rotation to take place in 2024?
Ah, it's tough to kind of uh, think about uh, these things in the short run. Um, but if I were to kind of uh, look at the crystal ball, uh, and I would say that this is please consult your advisors. But I would say one sector that hasn't, I mean, obviously private banks could be one of them, but uh, a dark horse could be FMCG, because that sector has really not done
Yeah,
well.
but
That sector could come back in 24 if inflation comes down, if interest rates come down and people's EMIs fall. There will be more discretionary income which will be left. So that's one sector which hasn't done well. It could be the dark horse for 2024.
wonderful. And this was my next question to you, Hirenji, that somehow the kind of money people have made in the 1990s and the early part of 2000, they've just completely forgotten about FMCG as well as the cement space, whereas one is, of course, a play on retail spending, the other on infrastructural spending, both of which are seeing a dramatic shift for positivity as far as markets are concerned. Your view on the cement space?
Very bullish. I think cement should do extremely well. Again, it's a sector which is getting even more consolidated. The
Yes.
bigger players are buying out the smaller players. I think housing and infrastructure should continue to grow next year as well. And a great way to play that would be through the cement sector, right? So we are quite bullish on the cement sector as well.
So, what would you be buying, or at least what is on your radar? The large cap cement players, or
I
the
think the
ones
large
that
cap.
might be?
I think the large cap cement guys will continue to become larger and larger as the industry gets consolidated. Right? It's a sector where volume and size leadership matters. Um, yeah, I mean, obviously, if you flip it around and say, okay, can I buy the really small companies which will get bought over, which are trading cheap? That's the other way to do it. But again, you have to be an expert at doing that. I'm assuming that, I'm talking to a general retail audience. I think you would be better off buying large cap cement companies.
Okay. With that, Hirenji, our time unfortunately draws to a close. It's been such a wonderful conversation over the last 40 minutes, which has been peppered with fantastic insights and great leads for the market in the months and years ahead. Thank you so much for your time, and I hope from now on we'll see you more frequently on Business Today.
Thank you, Sakshi, and thank you, Shail. Thanks for having me. Bye bye.
This really booming and flourishing bull market that we see on Dalal Street. From Sakshi and I and our team, thank you so much for watching.